I'm here with Jon Diorio of BlackRock. He's a managing director there who leads their alts to wealth platform here in the United States. And so, Jon, you have a lot of experience with model portfolios in particular. For the better part of a decade, you've worked with them. Maybe let's take a big step back. Even without thinking about alternatives for a second, how do you think about how advisors use model portfolios and how that's evolved?
First, thanks so much for having me, and thanks for the great partnership with iCapital. Model portfolios really started in the liquid side of the business. I think the first thing that model portfolios did was really create a durable, repeatable process for both advisors and for clients, and that's really important. And it's been really interesting. We talk a lot about asset allocation IP at BlackRock, and the great thing about a model portfolio is it shows you exactly what you should do with your money, right? Because we buy something, we have to sell something. So you understand the overweights and the underweights.
It's in essence making sure that when people are buying funds, they actually fit into a total portfolio.
Exactly. You get a holistic view of how things fit together and how those puzzle pieces come together. The second, I think, really important thing and why we've seen the model business grow is it creates a lot of time for both clients and financial advisors. It's very scalable. It allows you to spend more time thinking about other things, thinking about estate planning, thinking about taxes, thinking about where you're going to go with your strategic asset allocation and what model you should be in, because there's all these different flavors of models. And so for that reason, we've seen the model industry really blossom. It's about a $4 trillion plus industry today in the United States. At BlackRock, we think the business is probably going to go to 11 trillion. So it's going to continue to grow, especially as more and more advisors move to advisory practices and more clients want that scale.
11 trillion is such a big number. When you think about the models of the past, they were often aligned with other types of funds, even very liquid ones like ETFs. So how do alternatives now fit into a model portfolio?
Markets are evolving. And that toolkit that advisors and clients want is really evolving. And so if you think about if you're just investing in liquid assets, you're missing such a big part of the opportunity set. There's really three reasons that we see alternatives coming into model portfolios. The first is clients today have great access to alternatives. If you think about the wealth industry a decade ago, everything was a drawdown fund, and many clients didn't have access to those drawdown funds. Now, I think a lot of GPs are out there providing evergreen options that have monthly subscriptions and quarterly redemptions, and they can actually fit into model portfolios. The second is opportunity. One of the things that you've seen is that if you're not accessing the private market, you're missing out on that opportunity. The example I love is Amazon, right? When Amazon came public in the late 90s, it had a little bit over a $400 billion market cap. All of that growth that we've seen in Amazon today, it's over 2.5 trillion, has been in the public markets. But we know now companies are staying private longer, right? And so if you're not going into private markets, you're missing a real wealth creation opportunity for clients. The third reason is sometimes alternatives can be a little bit cumbersome. And so if you can get them into the model portfolio and you can take away some of that opaqueness, you can make it a lot easier for people to do. And so that I think are really the three reasons that we see it happening.
You know, it's interesting. I think a lot of people look at the model portfolio industry and they look at the alternatives industry and say, wait a minute, there's a great unlock here. There's a chance that models can make it so much easier for people to access alternatives. Do you believe that that could be true?
Absolutely. Today, that alternative business looks a lot like that mutual fund and ETF business over a decade ago. Client comes in and wants to buy maybe private credit. They love private credit because of the yield or because of the fact that it gives them a nice stable return, but they don't know how to put it in the portfolio. They don't know where it fits. And so a model portfolio can help with that. It can give you holistic advice into that whole portfolio. When you buy private credit doesn't have any duration to it. So where does it fit in your fixed income portfolio if a typical fixed income portfolio has 4 to 5 years of duration? So I think model portfolios can help with those types of things. And again, also make it easier so it goes right into the portfolio.
It's kind of letting the private assets sit alongside the public assets in a lot of ways for you guys in a very simple way.
Absolutely. I think the goal for the whole industry is to make alternatives feel less alternative, right? And private credit should fit into the fixed income sleeve. Private equity can fit into the equity sleeve. And we talk a lot about clients getting access to this, but it's really around what is the outcome that you're trying to do about the portfolio. And what it really comes down to us is it's really two things. You're usually trying to either diversify your portfolio or you're trying to enhance your risk-adjusted returns. And I think alternatives do both of that to the whole portfolio, and that's why clients should own them.
Now, you've done this for a while, and I'm wondering what has been successful about models. Why do clients gravitate towards them? Is it mostly those investment outcomes? Is it the ease of access or something else?
I think it's probably a little bit of both. A couple of the things that we've really concentrated on in our models business. One is the client is at the heart of everything that we do. So trying to have a great client experience for anybody that buys a BlackRock model is really table stakes for us. And what that means is when we do a rebalancing, we make sure all of our clients know we do big calls. We have attribution analysis, so you know exactly how the model's doing. And I think that's really important in alternatives. A lot of clients right now, we're finding they're having a hard time benchmarking how is your alternative product doing or what's happening in the portfolio. And so I think one of the things that models can do is maybe bring a little bit more transparency to how the whole portfolio fits together, but again, also try to make it a little bit easier for the client to understand how it fits in.
Well, what about the question of liquidity? You started to get to it a little bit earlier, liquidity, transparency. How do you tackle those topics when you guys are thinking about creating a model?
I think first and foremost, it's important to understand when you buy a model that has an alternative in it, especially if it's one of the evergreen funds that have monthly subscriptions and quarterly redemptions, it does not change the underlying makeup of the liquidity. And these funds are semi-liquid or have limited liquidity for a reason because they're trying to harvest that illiquidity premium. And so I think it's important. Sometimes clients think you put them into a model and it's a cure-all. It's not. But what we're doing is we have a professional portfolio management team that can think about the liquidity horizon, think about how it interacts with the liquid side of the portfolio. One of the interesting things that we did at BlackRock was we ran a study, actually. We run a big mutual fund business. And it was pretty interesting. The average hold time on our mutual funds is about 4.5 years. So that means basically there's about 20% turnover per year. If you think about most of these evergreen private market funds, they offer about 20% liquidity per year. So I think it's matching up that liquidity intention and making sure that you're getting the right liquidity in the portfolio.
But it's also saying leave the liquidity decisions to the experts in a lot of ways.
To some extent, yeah. I think financial advisors do a phenomenal job, but I think it's really around moving away from product into portfolio and thinking more holistically about it and getting some help on how you scale that. I think the important part is for the financial advisor, if you can scale that, it becomes a lot easier.
Now, you've given me this amazing prediction, if you will, in some ways, that 4 trillion of model portfolios can become almost triple, almost 12 trillion. You said 11 trillion. Why do you think the adoption is going to increase so much?
I think we're at a really important inflection point here in models where we are moving from those traditional kind of just liquid ETF mutual fund models to now being able to provide this bigger toolkit, right? And so imagine coming in and being able to run a model portfolio that gives you some tax loss harvesting, that allows you to buy maybe a tailored municipal bond portfolio. If you're a New York resident like myself, you might want a New York muni portfolio, and then getting alternatives. And so why I think it's going to grow is what we've been focused on at BlackRock is really the customized model business, right? So if you have a larger account, you can come in and we'll customize that for you and provide some of these higher net worth toolkit things that I just spoke about to give you a better experience. And I think that's going to give you a better outcome.
So bring us inside the factory a little bit. What's going on under the hood? The kinds of things that are developed by BlackRock or being developed by BlackRock today that can start to see advisor portfolios tomorrow.
There's 3 things that we're really focused on. The first 2 are for alternatives, which I know is really our focus today. So the first model portfolio, and we partnered with you all to launch this, was back in March. We came out with public and private models. Up until this point, there weren't any ways to get public and private markets together. What's to come next, I think, is multi-alt models. So there's many clients that might be good with their current public model, but they need some help on the alternative side. And so running a multi-alt model that has private equity and private credit and infrastructure and real assets, or even maybe some type of other diversifying type of strategy in there, we think will be really easy for clients to adopt. And the third one is, like I mentioned, trying to include an even wider toolkit, so things like tax loss harvesting and starting to think about things like taxes in the model portfolio is really, really important.
You mentioned multi-alternatives models, and it's interesting because I would presume, you tell me, BlackRock is probably differentiated because you have that range, public and private. But when it comes to the private side, the alternatives models alone, what fits best? What are the things clients are asking for to be in those types of models?
We're very excited at BlackRock about the multi-alt models. We've built out our alternatives business. Hopefully you've seen, we recently acquired HPS, we acquired GIP. So point one is we've been very focused on the private markets and trying to build out our set of solutions and our set of breadth. That said, also model portfolios can also be open architecture, so you can partner with others in the ecosystem if you don't have best in class. And I think ultimately what is going to really drive it, though, is getting away from the product and, again, getting to the portfolio, which is how does the private credit and the private equity and the infrastructure all interact with each other, and what are the different outcomes that you're trying to achieve in these types of models. And so we do a lot of risk modeling and a lot of analytics at BlackRock through our Aladdin system, through eFront, and we just recently bought a company called Preqin. So really trying to get the data and analytics to make sure that we can deliver better outcomes for clients.
Now, when you think about the entire alternatives industry, and you do lead the alts to wealth effort at BlackRock, it's clearly a moment where you're seeing structures change. You're seeing GPs, fund managers, really provide structures that might be more friendly to the wealth community. How do you think models fit into that bigger story?
Well, I think the entire financial community, I think, has moved more towards the advisory and advice. And so I think what you see with the structures now is that we think both kind of the evergreen structure and the drawdown structure work really well for clients. The drawdown structure is a little bit harder to put in models, right? Because you have capital calls, you have K1s, you have some things that are just not as convenient for a lot of clients, right? And so I think the exciting thing is, as you've had best-in-class product come to market in the evergreen space, you now have the breadth of product to build out these multi-alt or public-private models, and that's really important. I think that has happened and evolved over the last couple of years in the industry, and I think that's allowing us to have the aperture to deliver these great models.
It's about ease of access in so many ways also. When you made that comparison about how you're looking at funds now in the alternative space look more like what mutual funds kind of used to look like. How far does that go? How much ease of access do you think can be created, particularly as more models form?
Yeah, I mean, to us, again, the models is really about the outcome. The example that I sometimes use is it reminds me kind of like a GPS system back in the day. So if you remember, now everybody takes for granted, like, Google or Apple Maps on their phone. But I remember the days kind of traveling around and used to have that thing that you put on top of the
I think
car.
I have mine
Yeah,
saved somewhere.
or you printed out your directions,
Right.
right? So think about how it's evolved. You used to have to go to MapQuest and print out your directions, and then you had a machine that kind of sat in your car, but maybe the internet connection wasn't good, so you ended up going around the block a few times. So it's all around the experience about how you get there and delivering something that works really well and is convenient and that you can trust. And I think that's where we are in the models ecosystem, which is you want to have this great outcome, but you got to be like maniacally focused on the way you get there, and that it's easy to do, it's convenient, it's reliable. And so I think it's not only about delivering these models and having the right asset allocation IP to get you to that destination, but it's about the experience to make sure it works.
Last question for you. What excites you most about the direction of this part of the industry?
There's just so many more options. And so what we always say at BlackRock is that having a lot of options and complexity is a good thing, but you can get overwhelmed with it, right? And if you get overwhelmed with it and those options become complicated, that's where it becomes a bad thing. What I'm so excited about with models is it hopefully is going to provide a lot more access, but it also provides that ease of use to make it a little bit more simple to bring great solutions to clients.
Jon, thank you so much. That's Jon Diorio of BlackRock, who runs their alts to wealth business in the United States, for our latest series on model portfolios, model behavior.